You are listening to ChartingWealth.com's comprehensive review and forecast for the week beginning Monday, the 6th of February, 2017. Before we get to the news that moved the market in the past week and what might be moving into the coming week, let's go through our charts with particular emphasis, as we do on the comprehensive review every week, with the weekly chart for those of you who are doing your daily market worksheets. If you don't have a daily market worksheet and aren't using it, man, you need to. This is how you supercharge your training. As you listen to the program every day, you fill out that daily market worksheet. It helps you keep up with what's going on in the market, gives you a record, helps you put pen to paper and really think about what's happening. How do you get that? You go to the website chartingwealth.com, you sign up for our daily podcasts, and along with that, you will get links to our How to Read a Stock Chart video, a link to the layout that we use, and a link to a PDF that you can print out as many copies of the blank daily market worksheet. 3-hole punch that, put it into a notebook, fill it out every day. You've got a nice record and you can watch your training progress before your very eyes. Let's jump right in and see what's going on the weekly charts. We go to SPY, which is of course a Standard & Poor 500 exchange traded fund. It tracks those 500 big stocks in the market. What do we see going on the weekly? Well, it's continuing to move up. We have our trend line on the weekly chart. Going to adjust it just a little bit. And we continue to see movement above that trend line, crossed over going up back on the week ending the 25th of November on the weekly chart, and has continued to move up since then, sliding sideways for some time, but it is still moving up. Derivative oscillators losing a little bit of energy, but again, we're continuing to see upward movement. How much longer? We don't know. We are trend following. We don't forecast. We follow. We do what the charts tell us. That's the way to make real money in the market. Now, what's going on as far as jumping into a trade at this point? Well, the problem that we have right now on the S&P 500 is that the 2-day chart is still in negative territory when it comes to the PPO, the price percent oscillator. It rotated over going down back on the 30th of December and has basically, we've got a divergence going on. There's been some upward momentum in the S&P 500 since then, but not enough to actually bring around the price percent oscillator. And we're also negative on the derivative oscillator. So we don't have a trade there using our typical technique of waiting for the 2-day chart and the weekly chart to move in the same direction. They're both going in opposite directions at this point. The weekly up, the 2-day crossed over going down. Then we wait for a pullback on the 2-hour chart, and when it rotates around going in the same direction as both the bigger charts, the 2-day and the weekly, that's when we get in. Well, that's not happening. So we don't have a trade in the S&P 500 at this point. Now, of course, you could have hopped in on a weekly trade back in November, and you would have done nicely up until the current time. Although if you do note, the market did top out and has not reached that high again. It topped out on the 27th of January and hasn't gotten that high again. So who knows how long in the tooth this market is, how much longer it can continue to bound up. But we will see. We'll let the market lead us. Now let's go to the Qs. What is that? Well, that's the Nasdaq 100. And we adopted in the beginning of the new year jumping in on these weekly trades. And we actually went ahead and after doing some back testing, we jumped in and have been tracking our weekly trade we jumped into right around 121.87 or so on the Monday following the Friday close on the 6th of January. So on the 9th of January, we jumped in at 10:30 at about $121.87, and we've continued to ride that train, and we continue to watch what's going on. We've had nice upward movement. We actually have had a high over the last week of 25.81. The market closed at the end of the week at 25.18. Did lose a little bit after hitting that high, but we see that the weekly chart has continued to move up. Derivative oscillators continue to gain energy every week, and we continue to see the PPO climbing higher and moving up, not sideways, not heading toward the signal line for a down move at this point. Now, if we go and look at one of our more traditional trades, we can see that when after the weekly crossed over, the 2-day was already in an upward movement, and when we looked at the possibilities of jumping in, we found a couple of those. Of course, one of them started back on the 24th of January, where we had a nice climb up. Then that petered out, crossed over going down. That would have been a great getting out point right there once the market topped out. Moved down some and then gave another trigger point for entry sometime around the morning of the 2nd of February. And there's been a little bit of upward movement since then also. But I tell you what, we're focusing on more and more, looking for our vertical gold crossovers, and gold is a good color because that's what they've ended up being, quite a bit of gold cash in your pocket for those vertical crossovers and then entering them the following Monday after idiot hour has ended. So we're going to continue to track the accuracy of jumping into those. So far, they have been golden. And again, when I start talking about cash and trades, remember, we are not a stock calling service. We're an education firm. We're talking about you entering into virtual trades. We want you to practice with us. Open up an account at any of the online brokers. You can actually set up a virtual trading account for free, fund it with $1 million if you want. Then you start learning what we're talking about of how to enter and exit trades. Many of these virtual trading accounts very well mimic what it's like to really buy and sell in the market. They have them designed that way so you can train on them, get comfortable using them so that when you do develop a skill set, you can actually go into the market, trade, buy, sell, make money, and have it work for you. So please practice with us. That's where we are on the Qs. Now we're going to go back to our weekly chart, and we're going to take a look at the 20-year bond fund as represented by TLT. It has, at the end of the week, it appears that it barely crossed over going up, even with the last 3 weeks of down movement after 3 prior weeks of, well, actually started moving up. It crossed over on the 2-day chart sometime around the 23rd of December, right around Christmas time. Then it had sort of a flat week on the week ending the 30th of December, and then moved up for 2 weeks, and then sort of started a lot of indecision on the week ending the 20th of January, and then over the last 2 weeks has really found itself moving down. But because of all that upward momentum and the fact that the downward momentum has not been that strong, it did in the week crossing over going up. We are going to pay a lot of attention as we go into the new week as to what really happens, because we can see on the 2-day chart it has been going down since, and we basically have 1, 2, 3, 4, 5, 6. We have 1 day of 2-day candle of indecision, but we have 6 candles of down movement since TLT topped out on the 2-day candle ending the 17th of January. So we will continue to watch TLT. Going to be very leery about jumping into an up trade on Monday at 10:30 unless we see things really kicking around, because getting very close to crossing over going down on that 2-day chart. So we're just going to be leery and watch that. Now let's go back to our weekly chart, but go ahead now and write on your weekly chart that it has crossed over going up. We'll see if that holds through the next week. Because it's so weak, it could actually not sustain that and bounce right off, and it would look like it never even crossed. So let's now go from there back on our weekly chart to gold. Now gold was up 0.25% for the day on Friday. And what do we see going on gold? Well, gold crossed over on the week ending the 27th of January and went up over the course of the past week. In fact, the derivative oscillator gained energy, and the PPO separated itself further and is angling up quite nicely away from the signal line, again meaning this upward movement is continuing. We found a jumping in point on gold on the Monday following the crossover on the 27th. So we did go ahead and enter that market also. If we revert to our 2-day chart, what do we see going on? Oops, I'm sorry, I went to the 2-hour. The 2-day chart, what do we see going on? Well, the market has continued to move up. Derivative oscillators lost energy, but since we jumped into the market following that crossover, we have seen nothing but green upward moving candles, and we have seen some appreciation of a few dollars since jumping in. So again, our identification of these gold, these weekly vertical crossovers, jumping in that following week when the 2-day chart makes sense, which it did for us, has appreciated quite well, and we are gaining nice percentages in this new year. So we will continue to focus on making sure that we're finding good entry points and making sure that we're calculating the right time to exit with the maximum amount of profit possible. Folks, that's where we are as we come into a new week and wrap up the past week. What we always like to do after we look at our charts, and again, those of you that are following your charts with us, please make sure that you mark where all these charts are on the weekly. Let's jump into, for just a few minutes, what actually moved the market over this last week and what might be moving it over the coming week. What did we see happen? We saw that global equities gained on the week, and they showed continuing improvement. We saw U.S. employment figures improve. We saw improvements in manufacturing. We saw yields on the 10-year note fall to 2.43, from 2.5. So 2.43 from 2.5 just a week ago. And for the week, we also saw crude prices of West Texas Intermediate crude rise about $1 a barrel. And those tensions between the U.S. and Iran following an Iranian missile test. So, of course, we got all sorts of stuff across the world that can be affecting things. Now, when we focus a little more on the U.S., we see that U.S. payrolls have risen, but wage growth has slowed. The January employment report was somewhat less rosy than the 227,000 rise in payrolls would have indicated. There's a downward revision from 204,000 to 164,000 in November payrolls, and that saw a 3-month moving average drop of about 183,000 from 187,000. So wages rose only 2.5% year over year in January, and that was compared with a 2.9% in December. The unemployment rate did tick up to 4.8% in January from 4.7% in December. And labor participation, that's actually the people that are out there working, that rose to 62.9, up from 62.7 just a month ago. What do we see going on in other things? Well, the Fed leaves the policies unchanged. They did note an improvement in sentiment, and that is the U.S. Federal Reserve left its monetary policy unchanged at their first meeting of 2017. They did note that there were improving measures of consumer and business confidence, and presumably the improved sentiment is going to manifest itself in a faster growing economy later this year, and the market's been dialing back rate hike expectations in the last few weeks. Just less than 2 25 basis point hikes are going to be expected in 2017. We were originally looking at maybe the market was pricing in maybe 3 of those. So we'll continue to monitor that. What's going on over in the UK? Well, Parliament has given Theresa May the green light for the Brexit, so we'll continue to see how that shapes up, both affecting the UK itself and the European Union. Now, what has Donald Trump, our new president, done? Well, he and members of administration were chiding major trading partners for manipulating their currencies. He named three countries, Germany, Japan, and China. And he said this was resulting in currency market volatility. The Japanese Prime Minister noted that Japan was abiding by the G20 agreement not to employ competitive devaluation, and noting that super loose Bank of Japan monetary policy was really meant just to stave off deflation in their country. Angela Merkel from Germany said the European Central Bank's independent, and she doesn't question its policy. So we'll continue to see Trump focusing on what works for America. We also saw, for the first time since 2016, the Eurozone grew faster than the United States. So I'm sorry, that happened in 2016. This is the first time it's happened since 2008. And again, things in Greece continue to just stack up. They're now saying that the debt could become explosive. So scary stuff going on there. And lastly, last news on Trump, he's expected to sign an executive order that is going to establish framework for scaling back the Dodd-Frank Financial Reform Act that was enacted in the wake of the global financial crisis. So Trump actually did end up signing that at the end of the week, and it'll be interesting to see how that plays out and just what occurs. So what do we have happening over the course of this next week? A couple of things going on Tuesday. The Reserve Bank of Australia is going to hold its rate-setting meeting. China is also going to report its foreign exchange reserves. Now, again, any of the stuff from China that's super, super bad or super, super good can, of course, affect our markets, but nothing like a Fed meeting. We also see on Wednesday, China's going to report its trade balance. So again, those things can have some impact on the market, but nothing great unless there is really super bad or super good news. And then lastly, at the end of the week, Canada is going to release its January employment report. So again, not any big market-moving news expected over the course of the week, but we never know in these volatile times. That's why every day we will be with you, providing you with our daily review and forecast. And like we said, if you don't have that, it's easy to get. You go to chartingwealth.com and sign up, put in your first name, your email address. We'll fire that off to you. If you appreciate what we do, we love to hear from you. You can go to the Charting Wealth website, write us from there. You can also follow us on Facebook, Twitter, Instagram, YouTube. We appreciate everyone that goes to our YouTube channel and subscribes. One of the first places we put up all our information. Of course, the number one first place is the chartingwealth.com website. We also would appreciate you going to iTunes and subscribing to our podcast, giving us a 5-star rating, you guys, and saying something nice about us. You guys have made us as high as number 6 in the world in stock market podcasts, and we so appreciate that. We are here for you. Did another good training video on just basic charting techniques. We're going to be loading that up here in the next day or two. But thank you so much for being with us. Remember, that 10 minutes a day you spend with us is going to be building up that knowledge set for you so that you will reach financial independence when you're able to read these charts. It's like having the Wall Street Journal a day, 2 days, a week early. So work with us every single day. Just 10 minutes. That's all we ask. You can find 10 minutes to fill out that daily market worksheet and to listen, and it will be worth its weight in gold. God bless. Thanks so much from chartingwealth.com. Hope you have a great week.